Hello, today is Deepawali, the Festival of Lights, as well as a public holiday in Malaysia. I wish to take this opportunity to wish everyone a happy Deepawali. In this video, I'm going to discuss the basic characteristics of options. I hope you will be able to understand how these investment vehicles work. We are going to learn how to use Excel financial model to calculate the profit potential and loss exposure of call and put options. The Excel modeling can make the process easy, clear, and convenient. Let's learn together. What is an option? An option gives the holder the right to buy or sell a certain amount of an underlying asset at a specified price over a specified period of time. Option is a unique type of financial contract because it gives the buyer the right, but not the obligation, to do something. The buyer uses the option only if it is advantageous to do so. Option is considered as derivatives because their economic value is derived or stems from changes in the value of some other asset. Options are called contingent claims because their payoffs are contingent on the prices of other securities. We will look at two basic kinds of options, calls and puts. A call option gives the right to buy. A put option gives the right to sell. A put option can be viewed as the opposite of a call option. A call gives the holder the right to buy the security at the stated price within a certain time period. A put gives the holder the right to sell the security at the stated price within a certain time period. If we expect market price of the underlying asset to increase, we should buy call option. Buying call option is a simple and popular option strategy for bullish investors. If we expect market price of the underlying asset to decrease, we should buy put option. Buying put options is a simple and popular option strategy for bearish speculators. Options can be designed to provide a choice of when the contract can be exercised. European options can only be exercised on the expiration date, while American options can be exercised anytime up to the expiration date. The price that an investor pays to buy an option is called the option premium. Option premium is the market price of the option. We can also say that the purchase price of the option is called the premium. The premium is the amount the buyer pays the writer or seller of the option. An option's premium depends on characteristics of the option, such as its strike price, expiration date, and on the price of the underlying asset. Option premium is paid upfront. The option premium has two components, intrinsic value and time value. Intrinsic value or fundamental value is based upon current market price of the underlying assets. Time premium is the amount that option price exceeds the fundamental value. The closer to expiration, the lower the time premium. Intrinsic value is the difference between an in-the-money option strike price and the current market price of the underlying asset. The intrinsic value of a call is the difference between the asset's market price and the option strike price. When the market price is below the strike price, the intrinsic value is zero. A call has an intrinsic value whenever the market price of the underlying asset exceeds the strike price stipulated on the call. The intrinsic value of a put is the difference between the asset's market price and the option strike price. When the market price is above the strike price, the intrinsic value is zero. A put has an intrinsic value whenever the market price of the underlying asset is less than the strike price stipulated on the put. An option is described as in the money when its exercise would produce profits for its holder. An option is out of the money when exercise would be unprofitable. An option that has positive intrinsic value is in the money option. A call option is in the money when the asset price is greater than the exercise price. Conversely, a put option is in the money when the asset price is lower than the exercise price. Options are at the money when the asset price and the exercise price are equal. When the intrinsic value is zero, the option is out of the money. Next, we are going to learn how to use Excel to build a model for calculating the profit or loss of an option. To calculate the profit and loss for call and put option buyer using Excel, you can apply these two sets of formula. You can apply the max function in Excel. Call option will be in the money when the market price is higher than the exercise price. Otherwise, the intrinsic value will be zero. In contrast, put option will be in the money when the exercise price is higher than the market price. Otherwise, the intrinsic value will be zero. Take note that the option premium is deducted from the profit or loss of the option. For option seller, the seller has the opposite position as the buyer, since this is a zero-sum game. Let's try to calculate the profit or loss for a call and put option. An option contract has a strike price of $600. The call premium is $20 and the put premium is $20. Calculate the profit or loss for the call and put option if the market prices of the underlying asset range from $500 to $700. Draw a graph to show the relationship between the market price and the profit or loss of the options. I'm going to show you how to calculate the profit or loss for call option. A call option will be in the money if the market price is higher than the strike price. Long means buy and short means call. I'm going to type equal MAX, open bracket, point the market price, minus strike price, comma, 0, close bracket, minus the call premium. Take note that I'm going to fix the reference cell for strike price. I shall type F4, and I'm going to fix the reference cell for call premium too. I'm going to type F4 here. Enter. This is the loss when market price is 500. The loss is equivalent to the call premium. I can drag all the way down to obtain the rest of the answer. When market price is same as the strike price, the loss is the call premium. The break-even point is 620 when the profit and loss is 0. Option contracts represent a zero-sum game between the buyer and seller. The buyer's gain is the seller loss and vice versa. Therefore, I'm going to type equal, negative, and point this value. Enter. Then I'm going to drag all the way down for the rest of the answer. Next, I'm going to calculate the profit or loss for put option. A put option will be in the money if the market price is lower than the strike price. I'm going to type equal maximum MAX, open bracket, point the exercise price or strike price minus the market price, comma 0, close bracket, minus put premium. Take note that I will fix the reference cell for strike price. I'm going to type F4 here and fix the reference cell for put premium. I shall type F4 to obtain the string function. Enter. And this is the profit when the market price is lower than the strike price. The profit of 80 is obtained from 600 minus 500, the price difference of 100 minus a put premium of 20. Therefore, the value is 80. I can drag all the way down to obtain the rest of the answer. For short put position, option contracts represent a zero-sum game between the buyer and the seller. The buyer's gain is the seller loss and vice versa. Therefore, I can type equal negative of this value. Enter. And I can drag the cursor down to obtain the rest of the answer. Remember, the buyer gains is the seller loss. The figure shows the profit or loss earned by a call buyer and a call seller. If the market price is below $600 at the time of expiration, the call buyer will lose money on the call purchase. However, the amount of the call buyer's loss can be no more than $20. Risk of the buyer is limited to the call premium. The call buyer is in a loss position unless the market price rises to $620, which is the strike price of 600 plus the call premium of $20. The call buyer's break-even point is reached when the market price rises to a level equal to the strike price plus the call premium paid. For market prices above $620, the call buyer's profit per share will rise dollar for dollar with the market price. The call buyer's profit potential is unlimited when the underlying stock price rises above the break-even price. The call buyers have unlimited profit potential with limited loss potential. The seller or writer of a call option incurs the obligation to sell the underlying asset at a predetermined strike price if requested by the buyer of the call option or the call holder. If the market price is below $620 at the time of expiration, the call seller will make money on the call sale. The amount of the call seller's profit can be no more than $20. The call seller is in a profit position until the stock price rises above 620, which is the strike price of 600 plus the call premium of $20. For market price above 620, the call seller's loss per share will rise dollar for dollar with the market price. The call seller has unlimited loss potential with limited profit potential. Option transactions are zero-sum game, in which the call buyer's profit comes at the expense of the call seller. The profit of the writer has a payoff pattern that is the mirror image of the payoff pattern for the call buyer. This figure shows the profit or loss earned by a put buyer and a put seller. If the market price is above $580 at the time of expiration, the put buyer will lose money on the put purchase. However, the amount of the put buyer's loss can be no more than $20. Risk of the buyer is limited to the put premium. The put buyer is in a loss position unless the market price falls to $580, which is the strike price of 600 minus the put premium of 20. The put buyer's break-even point is reached when the market price of the underlying asset falls to a level equal to the strike price minus the put premium paid. For market price below $580, The put buyer's profit per share will rise dollar for dollar as the underlying asset price falls. The put buyer's profit potential is limited only by the fact that the price of the underlying asset can fall no lower than zero. The put buyer has limited loss potential and profit potential that is limited only by the fact that the underlying asset price can fall to no less than zero. The seller or writer of a put option incurs the obligation to buy the underlying asset at a predetermined strike price if requested by the buyer of the put option or the put holder. If the market price is above $580 at the time of expiration, the put seller will make money on the put sale. The amount of the put seller's profit can be no more than $20. The put seller is in a profit position until the stock price falls below $580, which is the strike price of $600 minus the put premium of $20. For market price below $580, the put seller loss per share will rise dollar for dollar as the underlying market price declines. The put seller has limited profit potential and have loss potential that is limited only by the fact that the underlying asset prices can fall no lower than zero. Option transactions are zero-sum game, in which the put buyer's profit comes at the expense of the put seller. The profit for the put writer has a payoff pattern that is the mirror image of the payoff pattern for the put buyer. Finally, we have come to the end of this video. Thank you for watching this video. Please practice the examples given in the Excel spreadsheet as practice makes perfect. I hope to see you again. Bye.